Welcome back to the Longacres Finance channel. Today I will be talking about my favorite dividend watch list, the one that focuses on high dividend growth. I am a long-term dividend investor, and I like a good dividend yield just as much as anyone. But what I like even more is high dividend increases. For me, there's no better feeling than seeing a 10 or 15 or 20% dividend increase announcement, and watching my dividend income soar to the sky. I know that high growth dividend stocks typically offer below average starting dividend yields. But if you are patient and have many years ahead of you, the reward can be worth the wait. So today I'm going to be talking about my top 15 high growth dividend stocks for the month of September. I've already published this list to my Patreon community and on Seeking Alpha. You can follow me there under the moniker Dividend Yield Theorist. This list was published on Seeking Alpha a few days ago, and I want to share it with you here today. But before we jump to the list, let's have a little recap on August. If the month of August finished a week earlier, the story would be much different. But in the market, you have to take the punches as they come. If you're a long-term dividend investor, market weakness should be seen as an opportunity rather than a punishment. My watchlist for August lost 4.88% last month. It underperformed VIG that lost 3.45% and SPY that lost 4.08%. However, since inception, which was September of 2020, the watchlist is still generating alpha over both benchmarks, but the gap has shrunk after August. The annualized alpha over VIG drops from 3.96% to 2.87%. And the annualized alpha over SPY drops from 4.01% to 3.27%. Additionally, after the poor results in August, the long-term annualized rate of return for the watchlist drops to 11.21%, which is below my target of 12%. Now the best thing to do after a losing month is to shake off the dust and start looking for opportunities. The main focus of this watchlist is to find the best combination of quality companies trading for attractive prices. I personally believe this is the optimal long-term strategy to building wealth. And I like to do it with dividend growth stocks. The top 15 dividend growth stocks for September offer an average dividend yield of 2.17%. Collectively, they have all increased their dividend payments at a rate of 32.43% during the last 5 years. And based on dividend yield theory, all of them look undervalued right now. And I personally think they are poised to offer strong long-term growth in the future. There are 8 main factors in the screener that I use to run this watchlist every month. And they are a market cap of at least $10 billion. A payout ratio that is no greater than 70%, a 5-year dividend growth rate of at least 5%, a 5-year revenue growth rate of at least 2%, a 5-year earnings per share growth rate of at least 2%, an S&P earnings and dividend rating of B+ or better, a wide or narrow economic moat reported by Morningstar, and an exemplary or standard management team also reported by Morningstar. So for September, the screener identified 112 stocks that met all of this criteria. I then used dividend yield theory to compute a valuation for each of these stocks. And all of the stocks were ranked based on quality and valuation, and then sorted by the best combination of both. And the final part of the process is to compute an estimated rate of return for each of these stocks. To compute this return estimate, I take the forecasted earnings growth, a return to fair value, and the current dividend yield. Once I have all this data put together, I select the 15 stocks that rank the highest, and also have a forecasted return estimate of at least 12%. My long-term hypothesis for this watchlist is that it will outperform a broad quality dividend fund, such as Vanguard's Dividend Appreciation ETF, ticker symbol VIG. So let's take a look at the watchlist for September now. In first place this month we have SS&C Technologies, which is an information technology stock. It offers a dividend yield of 1.42% and looks to be about 52% undervalued. They have a nice and low payout ratio of 27% and a 5-year dividend growth rate of 22.16%. My long-term return estimate for the company is about 21% per year. In second place we have Cigna, which is a healthcare stock. It currently offers a dividend yield of 1.57% and looks to be about 77% undervalued. However, this valuation is grossly overstated due to the fast dividend growth rate the company has experienced recently. It has a 5-year dividend growth rate of 151%, which means that its current dividend yield is way above its trailing dividend yield. Until this trailing dividend yield catches up, using dividend yield theory for this company isn't really effective. My long-term return estimate for Cigna is about 36%. However, this return estimate is also overstated as it's partially based on this valuation. In the third place this month we have Lowe's, which is a consumer discretionary stock. It currently offers a dividend yield of 2.13% and looks about 28% undervalued. Lowe's has a nice payout ratio of about 27% and a solid 5-year dividend growth rate of 17.32%. My long-term return estimate for the company is about 15.5%. In fourth place we have Domino's Pizza, another consumer discretionary stock. It currently offers a dividend yield of 1.16% and looks about 27% undervalued. Domino's has a nice payout ratio of about 31% and a very strong 5-year dividend growth rate of nearly 20%. My long-term return estimate for the company is about 14.5%. In 5th place this month we have Best Buy, another consumer discretionary stock. It currently offers a very attractive dividend yield of 4.7% and looks about 50% undervalued. Best Buy has a nice and low payout ratio of about 33%, and it also has a 5-year dividend growth rate of nearly 20%. My long-term return estimate for Best Buy is about 24%. In 6th place we have T. Rowe Price Group, which is a financial stock. It offers a nice dividend yield of 4.02% and looks about 38% undervalued. T. Rowe has a good payout ratio of about 44% and a good 5-year dividend growth rate of about 15%. My long-term return estimate is about 23%. In 7th place we have Advanced Auto Parts, another consumer discretionary stock. It offers a solid dividend yield of 3.52% and looks about 85% undervalued. However, similar to Cigna, Advanced Auto Parts has grown its dividend at a very fast rate during the last 5 years. As a result, its trailing dividend yield is significantly lower than its current yield. So again, dividend yield theory isn't a good valuation measure for this company. My long-term return estimate of about 43% is also grossly overstated. In 8th place we have Morgan Stanley, another financial stock. It offers a good dividend yield of 3.67% right now, and looks about 39% undervalued. Morgan Stanley has a nice and low payout ratio of about 38%, and a very strong 5-year dividend growth rate of 24.5%. My long-term return estimate is about 14%. In 9th place we have Tractor Supply, another consumer discretionary stock. It offers a nice dividend yield of 1.96% and looks about 36% undervalued. Tractor Supply has a nice and low payout ratio of about 31.5%, and a pretty good dividend growth rate of about 17.7%. My long-term return estimate is about 18% for the stock. In 10th place this month we have FMC, which is part of the materials sector. It offers a nice dividend yield of 1.93% and looks about 33% undervalued. It has a nice and low payout ratio of about 34%, and a strong 5-year dividend growth rate of nearly 24%. My long-term return estimate for the company is about 16% per year. In 11th place this month we have MSCI, which is a financial stock. It offers a rather low dividend yield of 1.1%, but looks about 17.5% undervalued right now. It has a good payout ratio of about 43% and a very strong 5-year dividend growth rate of nearly 30%. My long-term return estimate for MSCI is about 15% per year. In 12th place we have Home Depot, another consumer discretionary stock. It offers a good dividend yield of 2.59% and looks about 20% undervalued. Home Depot has a good payout ratio of about 43.6% and a very good 5-year dividend growth rate of 19.05%. My long-term return estimate for Home Depot is about 18.7% per year. In 13th place we have Ball Corporation, which is also part of the materials sector. They offer a dividend yield of 1.41% right now and look about 42% undervalued. Ball Corporation has a low payout ratio of about 35% and a very strong 5-year dividend growth rate of nearly 22%. My long-term return estimate for the company is about 17.7%. In 14th place we have Visa, which is an information technology stock. It offers a low dividend yield of 0.74% right now, but looks about 21% undervalued. Visa has a nice and low payout ratio of about 22% and a nice 5-year dividend growth rate of 18%. My long-term return estimate for the stock is nearly 20% per year. And in 15th place this month we have MasterCard, another information technology stock. They offer the lowest dividend yield on the watchlist this month of 0.6%, but look about 16% undervalued. MasterCard has a nice and low payout ratio below 20% and a very strong 5-year dividend growth rate of 18.29%. My long-term return estimate for the stock is about 21% per year. There you have the top 15 stocks on my high-growth dividend stock watchlist for the month of September. The average dividend yield for the watchlist this month is 2.17%. Collectively, all 15 stocks look about 39% undervalued. They have a combined 5-year dividend growth rate of 32.43%, which is a very strong dividend growth rate, and a combined average return forecast of about 21% per year. If we compare the August and September watchlist, there are 2 changes to the top 15 list. Blackstone and Charles Schwab have fallen further down the list, and they are replaced by MasterCard and Visa this month. Let's talk about past performance for a second. August was the 5th month this year where the watchlist underperformed VIG, and the 4th month where it underperformed SPY. However, on a year-to-date basis, the watchlist is still ahead of both benchmarks. It's generating 0.21% of alpha over VIG and 3.32% of alpha over SPY. Since the watchlist in August had a negative return, the annualized rate of return for the watchlist falls from 14.68% last month to 11.21% after August. And even though the current annualized rate of return is below this threshold, I am still optimistic this watchlist will meet my goal in the long run. Since I have started tracking this watchlist, there have been a total of 67 stocks that have appeared in the top 15 list. Here are the top 5 past and present watchlist stocks in terms of performance for August 2022. The best performing stock was Progressive, that was up 6.6%. In second place, we had Deere Company, that was up 6.43%. In third place, we had Charles Schwab, that was up 3.06%. In fourth place, we had Cigna, that was up 2.94%. And rounding out the top 5 was TJX Companies, that was up 2.42%. So 2 of the top 5 watchlist stocks from August were part of my watchlist, Schwab and Cigna. However, even though I selected 2 of the 5 best performing watchlist stocks last month, overall the watchlist performed poorly due to the other selections. And I will show you the performance for all of the August selections in a little bit. But before we get there, let's take a look at the 5 best stocks in terms of total return since joining the watchlist. The best performing stock on the watchlist is ADP, that is up 83% since joining 24 months ago. In second place, we have United Health Group, that is up nearly 59% over 19 months. In third place, we have Northrop Grumman, that is up 43.68% over 2 years. In fourth place, we have Progressive, that is up 43.59% over the past 19 months. And rounding up the top 5 is Costco, that is up 42.09% over the past 2 years. Seeing how not all of the stocks have been on the watchlist for the full 24 months, I also compare a monthly average return to help normalize the results. So here are the top 5 stocks with the highest average monthly return since joining the watchlist. In first place, we have Best Buy, that is up 4.13% per month over 2 months. In second place, we have Cigna, that is up 3.13% per month over 6 months. In third place, we have ADP, that is up 2.55% per month over 24 months. In fourth place, we have United Health Group, that is up 2.47% per month over 19 months. And in fifth place, we have Progressive, that is up 1.92% per month over 19 months. Best Buy and Cigna have been on the watchlist for relatively short periods of time. It'll be interesting to see if they can retain these top positions in the long term. Let's take a quick look at the performance for all the 15 stocks on the August list. 7 of the 15 selected stocks outperformed VIG last month. Schwab, Cigna, Lowe's, and Morgan Stanley had positive returns between 1 and 3%. FMC, Tiro, and Tractor Supply had negative returns but were better than VIG. And this means that the 8 remaining stocks underperformed VIG last month. Home Depot was pretty close as it lost 3.53%. Domino's Pizza and SS&C Technologies lost 5%. MSCI lost about 6.5%. Blackstone was down nearly 8%. Best Buy was down a little bit more than 8%. Advanced Auto Parts lost 12.9%. And Ball Corporation was the worst performing stock, losing nearly 24%. I still like the company, and I actually bought some more after it fell last month. It's difficult to watch one of your stocks fall 24% in a month. However, I still like this business, and now I have the opportunity to increase my position at a much lower cost. I personally think the best investing strategy for long-term dividend investors is to adopt a buy and hold investing strategy. This is one of the easiest and most tax-friendly investing strategies. Essentially, all you do is buy shares of your favorite stocks and hold these positions for a very long period of time. I started tracking how such a strategy would have worked out with this watchlist by tracking one portfolio that started in 2021 and another that started in 2022. Each portfolio assumes you invest equally amongst the chosen 15 stocks for the given month and never liquidate these positions. The 2021 buy and hold portfolio performed pretty poorly in August, losing 4.1%, so it slightly underperformed SPY and VIG. However, the cumulative return since January of 2021 for the portfolio is 11.32%, compared to 7.58% for VIG and 7.93% for SPY. If we annualize the returns, the portfolio is averaging 6.65% per year, compared to just 4.48% for VIG and 4.69% for SPY. This portfolio holds 54 unique positions, and the largest ones are Charles Schwab with a 5.86% allocation, Lowe's with a 5.76% allocation, Home Depot with a 5.36% allocation, United Healthcare with a 5.05% allocation, and Tractor Supply with a 4.84% allocation. The best performing positions in this portfolio have been Northrop Grumman, that is up nearly 53%, Progressive, that is up 44.6%, United Healthcare, that is up nearly 34%, FactSet Research System, that is up 32%, and Lockheed Martin, that is up 24.7%. The 2022 buy and hold portfolio performed even worse in August, losing 4.93%. Its year-to-date return is minus 15.96%. Which is worse than VIG that is down only 13.06% this year, but slightly better than SPY that is down 16.17%. There are 38 unique positions in this portfolio due to a high turnover on the watchlist because of all the market volatility this year. The 5 largest positions are Cigna with a nearly 6% allocation, Home Depot with a 5.94% allocation, Tractor Supply with a 5.72% allocation, Lowe's with a 5.06% allocation, and Charles Schwab with a 5.01% allocation. And the 5 best performing positions in this portfolio are Activision Blizzard that is up 18.66%, Cigna that is up 11.84%, Humana that is up 11.11%, Rollins that is up 10.42%, and Monolithic Power Systems that is up 7.45%. My expectations are for this watchlist to produce a long-term 12% annualized rate of return. For me, that is a sufficiently high enough return for my portfolio to generate. I personally use this watchlist along with my high-yield dividend watchlist to identify investing opportunities that I act on in my personal portfolio. That's it for today. If you enjoyed this video, I would appreciate if you gave it a like and subscribe to the channel. Thank you for watching and see you next time.